At 7:12 on a Tuesday morning, your car will not start. You turn the key once, nothing. Again, nothing. Your partner is already getting your child ready for school. You have work in less than an hour. The coffee is getting cold on the counter. And suddenly, the entire morning is built around one question. How are we paying for this? You are 36 years old. You live in the United States with your partner and one child. Your household brings in about $96,000 a year before taxes. That number is only an illustrative example. It is not an average, a prediction, or a definition of what any family should earn. From the outside, your life looks stable. You pay rent or a mortgage, you have a car, you have insurance, you buy groceries, you make the minimum payments, you might even take your child out for pizza on Friday night. You are not reckless. You are busy. And because you are busy, the emergency fund keeps getting pushed into the future. You tell yourself you will start after the next raise, after the credit card balance comes down, after the holidays, after the car is paid off, after life gets a little less expensive. But life does not usually become less expensive on its own. It simply finds a new place to send the money. Every month, your paycheck arrives and immediately gets divided. Housing, utilities, groceries, gas, insurance, child care, phone bills, debt payments, school expenses, a prescription, a birthday gift, a repair you did not expect. By the time the month is over, there may still be money in the account. But having money left over is not always the same thing as having financial flexibility. Because financial flexibility is not about what you can afford when everything goes according to plan. It is about what happens when the plan breaks. And at 36, that difference becomes more important. You may have people depending on you now. A partner, a child, a home that needs to function, a car that has to start, a job that expects you to show up. You may not feel financially fragile because the bills are getting paid. But then the car does not start. The mechanic calls later that afternoon. The repair is more than you expected. Not because anyone made a bad decision. Not because you bought something foolish. Just because cars break. Medical bills arrive. Work hours get reduced. A roof leaks. A child gets sick. An appliance fails at exactly the wrong time. That is what an emergency is. It is not necessarily dramatic. It is simply expensive before you are ready. Now imagine two versions of your life. Same age, same household, same income, same car, same repair bill. The difference is not intelligence. It is not discipline. It is not who works harder. The difference is what happened before the emergency arrived. In the first version of your life, you never built an emergency fund. Not because you did not care, because every month had a reason to spend the money somewhere else. Maybe you had planned to start with your next paycheck. Maybe you had tried before and had to use the money again. Maybe saving felt impossible when the rest of your budget already felt tight. So when the repair bill arrives, you look at your checking account. There is not enough. You look at your savings account. There is not much there either. The repair cannot wait. You need the car for work. You need the car for school drop-off. You need the car for groceries, appointments, and everything else that makes family life move. So you reach for the credit card, or you apply for a loan, or you delay another bill, or you borrow from someone you would rather not ask. The repair gets paid. The car starts again. For a moment, it feels like the problem is over. But it is not over. It has changed shape. The broken car is gone. Now there is a balance on the card. That balance becomes part of next month. And next month was already full. So the emergency does not disappear. It moves into your budget. It sits beside rent, beside groceries, beside insurance, beside every other payment that was already waiting for you. This is where people often misunderstand financial stress. The emergency itself may last one day. The payment can last much longer. The repair was not only expensive because of the number on the invoice, it became more expensive because you had no room to decide how to handle it. Without cash available, your choices get smaller. You may have to accept the first financing option offered. You may have to carry a credit card balance longer than you wanted. You may have to postpone another necessary expense. You may make a minimum payment because that is all the budget can hold. And then something else happens. Maybe a medical bill arrives after insurance. Maybe your child needs a dental visit. Maybe your partner loses a few shifts at work. Maybe your company cuts overtime. Maybe your refrigerator breaks. The details do not matter as much as the pattern. The second problem arrives while you are still paying for the first one. And now the question is no longer, how do we handle this expense? The question becomes, which problem are we willing to delay? That is a much more stressful question. You start moving money around. You wait a few days before paying one bill. You put groceries on the same card. You avoid checking the account because you already know what it will say. A weekend that should feel normal becomes an argument about money. A routine email from a doctor's office feels threatening. A car noise feels bigger than it is. A small unexpected charge feels personal. And this is how financial pressure changes daily life. Not always through one huge disaster. Sometimes through the constant feeling that another ordinary problem could knock over everything you are trying to hold together. Now, let us go back to the same Tuesday morning. Same car, same family, same repair bill. But this time, you built a cash reserve before the emergency happened. Not a perfect reserve. Not an unlimited amount of money. Not enough to make every future problem disappear. Just money set aside for the fact that life sometimes becomes expensive without asking permission. In this version, the mechanic calls with the same news. You still feel frustrated. You still wish the car had not broken. You still look at the repair bill and think about all the other things that money could have done. But you have options. You transfer money from the emergency fund. The savings balance drops. That does not feel good. It was not supposed to feel good. An emergency fund is not there to make you feel rich. It is there to be used when something real happens. You pay for the repair. The car is fixed. And now you have a new job. Rebuilding the reserve. You may rebuild it slowly. Maybe with automatic transfers after payday. Maybe with part of a tax refund. Maybe by sending a little more during months when expenses are lower. Maybe it takes longer than you hoped. But the emergency did not become a new payment that follows you into every month. That is the difference. The family with a reserve still has a problem. The family without a reserve has a problem plus a financing decision. And financing decisions made under pressure are rarely the decisions people would choose if they had more time. Cash gives you time. It gives you the ability to say, we can handle this today. Then make a plan tomorrow. Without cash, tomorrow's plan has to be made today. Usually while you are stressed, usually while the bill is due, usually while someone else is waiting for payment. This does not mean an emergency fund solves everything. It does not. A serious job loss, a major health event, or a large uninsured loss can be bigger than any reserve a household has built. There is no amount that guarantees financial security. And there is no universal number that every family should save. You may hear people say that everyone needs 3 months of expenses, or 6 months, or 1 year. Those can be useful reference points in some situations, but they are not universal laws. Your household may need a different approach. It depends on your essential monthly expenses, your job stability, your insurance coverage, your debt payments, your dependents, your access to family support, your income volatility, and the difference between what you can delay and what you cannot. A household with one steady income, strong benefits, low fixed expenses, and no dependents may face a different level of risk than a household with 2 children, a variable income, a long commute, high deductible health coverage, and several debt payments. The point is not to chase someone else's number. The point is to understand your own exposure. What would still have to be paid if income stopped for a while? Housing, food, utilities, transportation, insurance, medication, minimum debt payments, child care, the expenses that keep your household functioning. That is where the emergency fund conversation begins. Not with a magic number, with reality, and reality changes over time. At 36, you may be carrying more fixed responsibilities than you did at 26. You may have a larger home, a more expensive commute, a child who needs things you cannot simply postpone, parents who may need help later, a job that pays more but also ties your lifestyle to a higher monthly cost. That is why a raise does not automatically make a household safer. If every raise gets absorbed by a more expensive car, a larger home, more subscriptions, more debt, or higher everyday spending, your income may rise while your flexibility stays exactly the same. Or even gets worse. You can earn more and still have no cash available when something goes wrong. That is one of the quiet traps of adulthood. Your life gets more expensive in ways that feel reasonable, one decision at a time. A better apartment because your child needs more space. A safer car because you drive more. Convenience spending because you are exhausted. A bigger grocery bill because your family is growing. None of these choices make you irresponsible, but together they can make your budget less forgiving. And a less forgiving budget needs more protection. Now imagine the timeline from age 36 to 45. In path A, you continue without a real buffer, not because you are careless, because each emergency keeps taking away the money you hope to save. The credit card balance from one problem limits what you can do when the next problem appears. A repair becomes a payment. A payment becomes less room in the budget. Less room means more borrowing when another expense arrives. And over time, you may feel like you are working harder just to stay in the same place. You get a raise, but some of it goes toward old decisions made during emergencies. You get a bonus, but it disappears into a balance you have been carrying. You want to invest more, pay down debt faster, change jobs, move closer to family, or take a risk on a better opportunity. But every choice feels harder because there is no cushion under you. You are not only managing money, you are managing the consequences of having no margin. In path B, life is not perfect either. The emergency fund gets used. Then it gets rebuilt. Then it gets used again. There are still stressful months. There are still surprise expenses. There may still be debt, difficult decisions, and setbacks. But there is a difference in recovery speed. When an expense arrives, it does not automatically become long-term debt. When income changes temporarily, the household has more time to adjust. When the car needs work, the family can focus on fixing the car instead of immediately borrowing for it. When a better opportunity appears, there may be more room to consider it. The result is not guaranteed wealth. The result is more flexibility. And flexibility is valuable because it protects your ability to make choices. An emergency fund can help you avoid selling something at the wrong time. It can help reduce the need to miss payments. It can help you avoid turning a short-term problem into a long-term balance. It can help you say no to a bad financing option. It can help you stay calmer while you figure out what to do next. That does not mean you should ignore high-interest debt to save an arbitrary amount of cash. It does not mean every dollar should sit untouched forever. And it does not mean you need to wait until you have a large fund before you can make progress elsewhere. These are household decisions with trade-offs. But one principle remains useful. A small buffer can change the kind of decision you are forced to make. Even a modest amount of accessible cash can create a little space between an unexpected bill and a desperate choice. So where do you begin? Start smaller than your ego wants to start. People often avoid building an emergency fund because the final goal feels too large. They imagine that if they cannot save several months of expenses immediately, there is no point in saving anything. But that is like refusing to carry an umbrella because it cannot stop every storm. A small cash buffer may not handle a major crisis, but it can handle a prescription, a deductible, a tire, a utility bill that arrived at the wrong time, a school expense, a repair that would otherwise go on a credit card. Start with an amount that changes your next decision, not an amount that looks impressive online. Then define what counts as an emergency before you are in one. A true emergency is usually urgent, necessary, and unplanned. A broken car you need for work may qualify. A medical expense may qualify. A sudden income interruption may qualify. A vacation deal is not an emergency. A sale is not an emergency. A new phone because the latest one looks better is not an emergency. The clearer the definition, the easier it becomes to protect the money for the moments it was meant for. And when you use it, do not treat that as failure. Using an emergency fund for a real emergency is the fund doing its job. The next step is simply to rebuild it. Over time, increase the reserve when your household risk increases. If your fixed expenses rise, your buffer may need to rise. If your income becomes less predictable, your buffer may need to rise. If you take on more responsibilities, your buffer may need to rise. If your insurance changes and exposes you to more out-of-pocket costs, your buffer may need to rise. Your emergency fund should reflect the life you actually have, not the life you had 5 years ago. At 36, ignoring an emergency fund may not ruin your life overnight. That is not usually how it works. The cost is often quieter. It is the repair that becomes a balance. The balance that becomes a minimum payment. The payment that limits your next choice. The opportunity you cannot take because you cannot afford uncertainty. The stress that follows a normal bill because there is no room left in the plan. An emergency fund is not a trophy. It is not proof that you are better than someone else. It is not a guarantee that nothing bad will happen. It is simply a way to give your household more time, more options, and more room to recover. So, before you ask how much you should have, ask a different question. What would your family have to borrow for if the next emergency arrived tomorrow? Subscribe to Jack Talks Finance for more practical stories about the decisions that shape everyday financial life.